It's one of the most exciting sectors in the market, but right now it's on a really big pullback. Is it time for a turnaround? Joining us today is MarketBeat analyst Chris Markoch with a look at 3 ways to invest in rare earth minerals. Chris, this is a huge topic that really came up last year, just about a year ago, and it started to work its way up to those highs it saw towards the end of last year. But for most of 2026, it seems like most of this sector has really been on a downtrend.
This is a case where the stocks got ahead of the story a little bit. There's no question that this is going to be a sector for investors to be looking at for the next 3 to 5 to 10 years. But the stocks really got overextended and they've been on a little bit of a pullback then. But I think that's an opportunity.
Yeah, it's an opportunity, and there are so many names to look at within that opportunity. When you talk about rare earth minerals, sometimes referred to rare earth mining, it covers such a wide area and really a vast number of companies right now. So what do we specifically mean when we talk about this type of opportunity in the market?
That's a good question, Bridget, and it's important to note. So when we're talking about rare earth metals, we're talking about a group of 17 specific metallic elements that have unusual magnetic, optical, constructive properties. The key for investors to realize, as far as why this is such an investable theme, is that these metals are baked into almost everything that's driving the current market. We're talking about defense systems, AI and semiconductors, EVs, wind turbines, cell phones. You just simply can't have a modern economy without these metals. And that's why they're so critical.
They're so critical. And until recently, most of these critical minerals have been coming from overseas somewhere, right?
Yeah, primarily from China. And that's where it's important for investors to really understand, kind of separate the myth from the reality, because part of the myth is that rare earths only exist in China, and that's not the case at all. Actually, rare earth metals are fairly, I wouldn't say prolific, but I would say they're common in many countries, including the United States and Canada and Australia. But what the key has been, and where the bottleneck has occurred, is that China has, in the last several decades, has been doing the work to refine the rare earth metals into that form that can be used for all these applications that we needed.
So they have those refineries, they have that whole process down.
Correct.
And that takes infrastructure, that takes years to build. And we know part of this rare earth story, again, we're about to get into the 3 ways to invest here that Chris is talking about. And it's different from what we normally hear on this channel. So I'm excited to talk about it. But what we're talking about is building an infrastructure that takes a lot of money and a lot of time. And we know the US government has actually been invested in this with some specific companies. And those are names we've talked about quite a bit, Chris. Is that impacting this market too?
You're hitting on a really important point, Bridget. This is a long-term story, and you've got some investors that they kind of think that they want to be in this for the long haul until the market gets overheated or until there's a pullback, and then they decide they want to get out. This is a story that's going to play out over time, and you're going to see some peaks and valleys, some ups and downs. You're going to have to be willing to ride with that volatility. But if you believe in the structural case that the economy simply isn't going to be able to function without these metals, and the United States and other countries are aggressively trying to build an infrastructure to not only mine for, but refine these metals, then you kind of know that over time, the general trend's going to be up and to the right. It's just going to be depending on where you get in and how you get in. And that's where exchange traded funds, ETFs, may be a good option for some investors.
And that's a great segue, Chris, into what we are going to talk about today. Chris has 3 ETFs for us to talk about. All of them approach the rare earth sector in a different way. And so I'm excited to dive into these 3 names and also talk a little bit more about ETFs. We've heard from plenty of our viewers who've been asking us to cover different ETFs because I know for some investors, Chris, there's a preference to look at ETFs to help avoid or at least not feel so much of the volatility that picking individual stocks can bring to your portfolio, especially stocks stocks that can so easily move on good news or bad news. And so that's where these ETFs really come into play for investors. If you are someone who really likes ETFs, make sure to check out this new article on MarketBeat too. It's 3 active ETFs to ride the hands-on management trend. A little bit of a different headline there, but it's different ETFs that are very uniquely put together. And if you want to take a look at that article, it's a free look and another list, an explanation of why those names are interesting for investors to look at. Scan the QR code or click that link down in the description. It'll take you right to that article on MarketBeat. And Chris, let's talk about, before we get to the first ETF name here, what you like about ETFs as an investor.
I don't always love ETFs. I enjoy the hunt, and I enjoy looking for specific companies to invest in specific sectors. However, I am invested in a couple of ETFs, and I like ETFs in the rare earth space for a couple of reasons. The first is, if you think about things like gold mining stocks or uranium mining, this is a specialty business model. There's a lot of things that are very complicated about their business model. This isn't like, a McDonald's business model or, or even like an Exxon Chevron business model. There's a lot of different things that investors have to consider. And if you don't have the time or the expertise in that sort of field, picking individual stocks can carry a great deal more risk. That's where the ETF comes in. You're kind of outsourcing that due diligence to a certain extent to people who have already done it, and they've said, here's a basket of stocks. Your trade-off is, and I heard this said once by a former MarketBeat colleague, who she said, you're taking the trash with the treasure with ETFs. And I think that's the concern. But I think in this case with rare earths, the benefit outweighs that risk, because you're really trying to make sure that you get exposure to the sector, but you're taking away the larger risk of saying, what if I pick 1 or 2 stocks and I'm wrong?
Yeah, I think every investor can relate to that feeling of picking a stock that you're excited about and you're wrong. I think if you're, especially in some of these more up and coming developing small cap names, which
Yeah,
many of these are, that
absolutely.
tends to be the case. They're not all going to be winners. That is the risk that you play in the small caps area, and that is why an ETF in this sector is really interesting. Let's get to the first one. Again, I mentioned earlier, all 3 of these are structured a little bit differently. So what's the first ETF that you're looking at in rare earths?
Of the 3 ETFs I'm going to talk about, this one's the most direct pure play on this whole idea of mining and processing and refining rare earth metals. And the ETF is the VanEck Rare Earth and Strategic Metals ETF. The ticker symbol is REMX. So this is tracking a list of global companies that mine, refine, or recycle rare earth strategic minerals. And again, it's the most direct way to play that theme.
All right. So when you say most direct, what does that mean? Is every stock within this ETF directly tied to that? Is it maybe a more narrow list, or there are not as many names on it?
A little bit of both. Yes, they are all directly tied to that theme. And also, this is a market cap weighted index, and it's only got 38 holdings. That's not a ton. There's a lot of ETFs that have 50 or more stocks in it. So this one's only got 38. Albemarle is the top holding by weight at around 7.2%. The fund only has, and I say only has about $2.4 billion of assets under management. It's got a net expense ratio of 0.58%, which is okay. I mean, it's not a low expense ratio, but it's probably what you would expect to pay for an ETF that's in a sector like this.
So this is the biggest pure play on the rare earth stocks and direct ties. How has the stock performed in the last few months, especially because many of these very direct rare earth stocks have had a really rough last couple of months?
As of today, when we're taping this, the stock's up just a little over 65% in the last 12 months. But what's been interesting is, as you pointed out, Bridget, it's had a really sharp pullback, about 22% in the last 3 months. Now, some investors will hear that and they'll say, well, have I missed it? Or is it time to buy the dip? Or I think the interesting thing is, even with this 22% pullback, the stock is still trading in about the middle of its
Mhm.
52-week range. So that really isn't saying that the thesis is wrong. It's just saying that maybe the stock got a little bit overheated and now it's pulled back. And that could give investors a really nice entry point right now, rather than try to figure out and try to time where a bottom might be. This might just be a good point to get in and say, okay, it's well off the highs, and that gives you a lot of room to grow.
I think it's the best argument for looking at rare earths right now is so many retail investors in particular tend to pay attention to stocks when they're hot, when they're in all of the headlines, when everyone is talking about it. And I think now is a really interesting time to be looking at adding a position in the rare earth sector because of that pullback. The same question I always have, though, when we talk about a sector pulling back, was this a necessary pullback? Could it pull back even more? Or do you think that this is or do you think that it has pulled back enough that is attractive to get into?
So I think the answer to both questions is yes, which may sound contradictory, but you can't really time the market, and there's always a possibility that these stocks could have further to drop. Okay. This is a multi-year story. We're only at the beginning of that story. There's a possibility that this ETF and the stocks involved could have further to drop. But if you believe in the long term, the thesis that that the United States, among other countries, is trying to actively move that supply chain for refining these rare earths onshore, then you would say you kind of have to pick an entry point and then just sort of play with your exposure from there, you know, buying the stock down as it goes down, or just, riding the stock up as it goes up. But I think, again, the idea is this is the time to get exposure to this market. And with the stock pulling it's had a 20% pullback. That's a pretty good time to get in.
Now let's move on to the second ETF you're looking at because the stock story going to be somewhat similar for all three of these ETFs, but at least a little bit different because they are set up differently. What's different about this second ETF you're looking at?
Right. So the second one we're talking about is the Global X Rare Earth and Critical Materials ETF. The ticker symbol is EART. So Earth without the H. Where this is different is this ETF is far more targeted at the application side of rare earths.
Mm.
So rather than the extraction and refining, which it does do some of that, this ETF has companies that produce the rare earths components and raw materials that are needed for specific applications: EVs, energy storage, robotics, radar systems. So it's less about the supply chain and it's more about the end applications for that.
All right, so give us some specific examples. What holdings are in this ETF?
You've got names like Freeport McMoran. That's one of the top names by weight in this. You've also got Southern Copper. Albemarle again comes up in this one, and as well as MP Materials, which is more of a pure play on rare earth. So like I said, you're getting a little bit of broader exposure, but in areas that are more application specific. By the way, there's about 50 holdings in this fund. So like we said, the other one only had about 38. This has about 50. And you're talking about 40 million in assets under management, an expense ratio of around 0.59%. So it's very comparable to what you would have with the REMX.
Let's talk about the number of holdings in this ETF and how that can impact the stock. Does it help maybe level out some of the volatility, the more names that you have in an ETF, or is that not always the case?
Um, I think in general it's supposed to be, because the idea is if you have more holdings, then no holding is going to have an excessive amount of weight in the fund. In this case, the largest weighting by percent is Anglo American PLC with 5%. So again, no holding in the fund carries more than 5% of the weight. That's the way to diversify that risk. Of course, critics would say that's a way of limiting your upside too. But I think, again, more investors are, when they gravitate towards an ETF, they're gravitating towards it for the idea of limiting the risk, not so much maximizing the gain.
Yeah, I think now is a really good time when we're talking about minimizing the risk to just do a comparison to one of the biggest pure plays out there, and that's USAR. This is a name that comes
Yeah.
up all the time on this channel. And you look at that chart compared to what's happening in this ETF, and the volatility is definitely different. There's far bigger spikes in USAR, which is why some people prefer picking individual stocks, but there's much sharper drops with this name as well. And so I think you can just see that in the chart comparison of you're in for a different kind of ride with the rare earth story if you look at an ETF versus an individual stock. And again, that I want to discuss that argument a little bit that some investors have of I don't like ETFs because you can't get the same kind of really big gains that you can in an individual stock. But you look at USAR, that one is up 60% for the year. And this ETF with 50 holdings is up 50% for the year. So they both have had a really strong last 12 months, even with this recent pullback.
Really, it comes down to, I really think a lot of it comes down to an investor's disposition rather than their knowledge, because there's a lot of people that invest in this space or in any other space, and they really don't necessarily have the knowledge of the industry, but it really comes down to your disposition and the idea of, are you able to absorb that volatility? Is that something that's going to keep you awake at night? Are you, is if the stock drops 20 to 30% in 3 months, are you going to be panicking and saying you've got to get out of it? Because that's not a healthy way to invest. It's not a healthy way to live, but it's also not a healthy way to invest. But if you're willing to ride out that volatility, if you're saying, no, I believe in what this company does, I believe in the thesis, there's nothing that's changed in the thesis, this is just price volatility, then yes, then you can use those dips as the opportunities to accumulate more and to position yourself better.
Yeah, I think that's a great explanation. And also disposition is so true. It just depends on risk tolerance and so many different factors about what you prefer. I hope that people are enjoying this ETF video. If you are somebody who is more disposition for ETF, also great argument, Chris, about ETFs just take less of your time as an investor because you don't have to do quite as much research. It's spread out more. So I also think that these are good time-saving options for investors too. If that's you and you like those, I want to remind you about that ETF article that just came out on MarketBeat. If you want to take a look at that one, it's a very different thesis of different kinds of ETFs to look at. Scan the QR code or get that link in the description to take a look at that other ETF article on marketbeat.com. Again, it's totally free for our viewers and just some more information and ideas to look at for you. And Chris, at the end of the day, that's what this channel is all about, is interesting stock ideas for people to see what feels best for them and do their own research and make their own decisions on investing. And so let's get on to that third idea that you have for investors today as an ETF to follow in the rare earth mineral sector.
This is the Sprott Critical Materials ETF. Ticker symbol is SETM. In a nutshell, here's what we're talking about. Where the last ETF we talked about, the EART, narrowed in on rare earths specifically and more towards those end use applications, the SETM has a broader exposure to a universe of critical materials, not necessarily just rare earths. For example, some of the largest companies by weight in this ETF are uranium companies, which we, of course, have talked about a lot on this channel and will continue to talk a lot about on this channel.
Okay, interesting. So this goes beyond some of those 17 critical minerals you're just talking about. It's really
Absolutely.
talking about, let's take a look at the specific holdings that are in this one and how many are in this one too.
There are a lot more holdings. This fund has held between 125 to 170 companies at any given time. By far, the most diversified of the three. The total assets under management as of the time we're taping this right now is around 541 million. That's something to think about. It's also got an expense ratio of around 0.65%. Again, that's larger than the two we've talked about. It's getting a little bit heavier for some investors. Some investors might not like that, but it does track well with an ETF that's got this broad and complex of a basket.
Yeah, and also so interesting to see that this one is broader. It has so many more names than the last two. And yet the chart looks very similar, especially when you look at the 1-year performance and the 3-month performance. It's right on par with the other ones that we've been looking at, even fairly similar to just USAR as a single stock, both up about 50 to 60% in the last year and down about 20% in the last 3 months. So that is interesting to see that even though you have a broader, more diversified ETF, it's still performing fairly similarly.
That goes back to something we were talking about at the beginning. The stocks just got ahead of the story. There is a long-term story for why you want to be invested in rare earths that's no different than why you want to be invested in space. And it's just, I think you're seeing a very similar thing happening in both sectors. The stocks got ahead of themselves. They pulled back. Investors that are looking to get in on the space, and especially if they're looking to get in an ETF, now would be a good time to consider getting in when it's about that middle of the 52-week range. Yes, the stocks may move a little bit lower, but the most important thing right now is you're getting in, and you're getting in when it's not at the top.
Yes, and that is exactly the question that I wanted to talk about a little bit more. And that is this concept I've heard from plenty of investors of once they've been burned by a stock or a sector, they're hesitant to want to get in it again, or are constantly questioning whether they should just give up and sell the stock that they bought that they're now down 20% on in the last 3 months. And they say, is it time to give up? Should I get out of this stock now? Because I've already been bleeding so much on this name. And that's a concept we've heard time and time again, not just in rare earths, but in so many different sectors. We've heard that with quantum at different times. We've even heard that in AI at different times as things cycle down and then they pop back up a couple of weeks later. And so what do you think about that concept of I'm ready to give up on this one? Is it time to get out?
That's a hard one to answer, Bridget. And again, we don't like to give personal advice, and I wouldn't give any investor personalized investment advice on the channel. But what I would say is this goes back to something I said earlier, and that is I think it speaks a lot to a person's disposition when they're looking at these stocks. If you're looking at the space sector, if you're looking at the rare earth sector, these are sectors that are long-term plays. The story is still being written. And sometimes, yeah, it's very tempting to get on these stocks, even quantum to that, to that effect. These are still very early stage companies, and you're going to get a lot of volatility, especially because in some cases, institutions aren't heavily involved. And, again, you're just going to see some volatility there. The best advice I could give, and some investors may not like it, some will, but it's the idea of knowing what you own. And if you're not knowing what you own, doesn't mean that you have to be an expert by vocation or by just interest. I mean, you can learn about space, you can learn about these things, but if you simply just don't understand the sector, or you really don't want to take the time to understand the sector, then it's probably best that you're not in that sector. There's plenty of other options, and there's plenty of other opportunities for investors. It's never just going to be one sector that you can invest in and be profitable. And that's the whole thing. If mining stocks or rare earth stocks are not a sector that really interests you, and you don't really think you're going to want to learn about them, then it's probably best that you stay away from them, even if you're missing the potential for those gains, because there's other ways you can easily make money in the market.
Really great information for everyone today, Chris. And if you are an investor who likes to hear about different sectors when they are on the downtrend and not when they're at their new high, make sure to watch this interview with our Jeffrey Neal Johnson, where he talks about the nuclear sector, which is very much down right now. He also talks about uranium mining companies in there too. There are, I think, a total of 9 different stocks that he covers in this video. You can watch that whole interview here.